Hello, good morning, everyone. Welcome to this week's research morning call. Now, today we got quite a few stock counter updates, Netflix, ASML, TSMC, as well as S-REIT ETFs, US banks, Keppel DC. For the macro sector, we have Magnificent Seven, Singapore Rate Monthly, and last but not least, our usual SG Weekly and technical analysis. So without further ado, I'll pass my time to my colleague Glenn to start with the US banks.
Yeah, thanks, Helena. Yeah, so we just start off with Bank of America first. So, yeah, Bank of America released their third quarter results. Their 9-month PATMI was at 72% of our forecast, so it fell slightly below our estimates, mainly from lower than expected net interest income as well as investment banking fees. So, overall, for the positives, the fees have continued to surge from higher market levels, mainly benefiting the asset management fees, which was up 14% year on year from the higher market levels as well as strong AUM flows, and also their global markets revenue. So this is their trading and brokerage revenue, which was up 14% year on year, mainly from higher FICC revenue as well as higher equities revenue. For the second positive is that their investment banking fees have continued to rise as well. So this growth was led mainly by the debt capital market fees, mostly in leverage finance and investment grade. Resultantly, their investment banking fees rose 18% year on year. As for the negatives, the first negative being that their net interest income has continued to dip. So it fell 3% year on year due to higher deposit costs, and also their cost of funds was continued to outpace the rise in asset yields. For the second negative is that their provisions have also ticked up. This was mainly due to net charge-offs, which have risen by 65% year on year from higher credit card and commercial real estate office. As for the outlook, Bank of America is guiding for net interest income of around 14.3 billion for the fourth quarter. And they have also mentioned several times that they believe net interest income has bottomed in the second quarter. So we have seen a quarter on quarter small increase in the third quarter, and we're expecting the similarly for the fourth quarter to be slightly higher or slightly higher than the third quarter. So Q on Q, there should be some growth. And this growth is kept coming from the fixed asset repricing of around $20 billion worth of fixed rate loans and securities, which will be repriced into higher yielding assets. So we should see their asset yield improving quite a bit more. As for the other outlook, we're looking at their loans also. Their loans, they only saw a 1% year-on-year increase for the third quarter. So I think we will still continue to expect that this will come in at a low single digit for FY24. We do upgrade to an accumulate with a lower target price of $44 as we account for the recent share price performance and lower our FY24 estimates from lower net interest income as well as market making estimates. We do expect Bank of America's EPS to improve by 30% year on year in the fourth quarter, and this is mainly due to the low base that they had in the fourth quarter of 2023. So they did really badly in the previous year for the fourth quarter. So we're expecting that this will improve mainly from higher net interest income from the fixed asset repricing I mentioned earlier, continued growth in their investment banking and wealth management fees due to the higher capital markets activity, as well as for their expenses to remain stable quarter on quarter going into the rest of the year. So that's all for Bank of America. I'll now move to Wells Fargo. Yep, so for Wells Fargo, the 9-month PATMI was at around 79% of our forecast, and this came in slightly above our estimates. They did record lower net interest income, which was partially offset by higher investment advisory as well as investment banking fees. So straight to the positives, the first positive being that their non-interest income has continued to support their earnings. So total non-interest income growth of around 12% came from higher net gains from trading activities, which was up 14%, as well as higher investment banking fees, which was up 37%. And lastly, an increase in the investment advisory fees as well as brokerage commissions. So it's quite a similar story as we have seen in Bank of America, where the fees were benefiting the earnings. Expenses, second positive is that the expenses growth was also controlled. So previously, we have seen for Wells Fargo is that their expense growth was kept increasing year on year and quarter on quarter. But currently we are seeing it, it's quite flat year on year for the third quarter. As for the negative, similarly, their net interest income has continued to decline. So their net interest income fell 11%, also due to the same reasons that the cost of funding is continued to outpace the asset yield. As for the loans, it fell by 3% year on year. So there were declines across most loan categories, except for the credit card business, which continued to grow. And the last negative is that their net charge-offs rose 29% year on year, and resultantly, their net charge-off ratio was higher by 13 basis points year on year at 0.49%. But nonetheless, this was more than offset by a lower allowance for credit losses across most loan portfolios. So resultantly, their provisions did fall by 11% year on year. As for the outlook, Wells Fargo is expecting net interest income to come in lower than they have previously guided. So previously, they expected it to be 7 to 9% decline in FY24 net interest income, but now they are on the higher end of that at a 9% decline for FY24 net interest income. So this points us that we're looking at the fourth quarter net interest income to be same quarter on quarter, so similar to the third quarter levels that we have seen. As for their guidance for expenses, it's remained unchanged at 54 billion. So I think it should still remain quite flat and stable. So we believe that the fee income will be the growth driver for Wells Fargo. So they have continually spent in their corporate investment banking workforce, especially in the trading, enhancing revenue and market share. So we do expect that higher market levels are expected to increase their wealth and investment management fees. And last but not least, we have seen their share buybacks also increase quite drastically. So in the third quarter, there was 3.5 billion of buybacks. That was an increase of 133%. And so if we assume a very modest increase of 10%, we could see their EPS already rising by 9% year on year. So we do upgrade to an accumulate with a higher target price of $65 as we increased FY24 earnings by around 5%, as we raise their investment banking estimates and lower expense and provision estimates. So despite an 8% decline expected in the fourth quarter in net interest income, so it's a year-on-year 8% decline, we do expect that their fourth quarter EPS will still improve by 10%, and this is mainly from growth in their non-interest income, particularly the continued recovery in their investment banking fees and higher gains from trading activities, as well as lower expenses and provisions. So that's for Wells Fargo. So we've just done Wells Fargo and Bank of America. Now moving on to the next slide, I'll just do a quick, since most of the banks have actually released, at least all the banks that we cover have released their results and we've released the reports. We'll just do a quick review and recap of the third quarter results. So here are the three banks that we cover and Citibank. So basically the top four biggest US banks. You can see that overall net interest income was down across the board except for JPM, mainly due to the reason that they were able to use a lot of their funding to reinvest and then get higher interest rates. So that's the reason why they are able to get a slightly higher net interest income, and also the fact that they had all the acquisitions from First Republic helping them as well. But you look at non-interest income, it's a similar story also across the board, which is that all the banks have benefited greatly from their non-interest income, and this is mainly coming from the investment banking as well as the asset management fee income. So these two was what actually helped the US banks. And last but not least, if you look at loans, let me go on loans first. Loans was also roughly similar. You're looking at low single digit or a bit of a decline. So that's to be expected. We should see it improve going into hopefully the next year with the lower interest rates. And last but not least, looking at the EPS. EPS was down also across the board because not so much that they weren't doing well, but because year on year previously they did extremely well, right? So there was a bit of a mountain to climb and they weren't able to really reach the peak. So that's why there was a bit of a decline across the board. But what's most important is that all the banks actually beat estimates with their EPS and their revenue figures. Yeah, so that's all for so we do like out of the three banks that we cover, we do prefer Bank of America. It's mainly due to mainly due to them having a larger portion of their revenue or their income coming from the fee-based income, right? So they're not really as concentrated so much into net interest income. So it's a lot of fee-based income. And in this environment, with interest rates coming down, we do feel that there's much more room for them to grow their fee income, and they'll be able to benefit more. And also, we do also feel that they have a lot more room to grow in the fourth quarter of the year because they were coming off a very low base in the previous year. So that's all I have for the US banks. I'll now hand it over to John for Netflix. Thank you.
Yeah, thanks, Glenn. Good morning, everyone. Just run through Netflix's third quarter earnings. We shared a report last week titled "Solid Results," but valuations seem full. So overall for Netflix, actually they did fairly well. Revenue was slightly above expectations and even guidance, while PATMI was also higher due to better top line growth and favorable timing of content spend. In terms of year to date, revenue and PATMI came in at 74% and 84% of our forecast. In terms of the positives, like I said, results were good. Membership growth remains quite healthy, about 14%. So somewhere in the mid-teens is kind of a sweet spot for them so far. At the same time, and then obviously, if when they start raising prices, or which they've done, then that just kind of benefits the overall revenue and bottom line as well, because it's basically full. There's basically no impact on margins, or rather, no impact on cost to raise prices. The next positive is that their ads business is actually doing really well, though they are still relatively small. Memberships continue to grow like this 30% quarter-on-quarter rate, which right now represents, we estimate, about 70 million memberships out of the 280 total memberships are actually ads based. So they are your cheaper basic ads plan, which is in the US is going for about $6.99 US. But I mean they've grown this significantly from basically zero 2 years ago. So it's doing well. It presents a very good opportunity for margin expansion because, as everybody knows, advertising revenue is significantly higher in margin versus almost anything else. It's just that because it's such a small scale, it doesn't have. We don't expect any significant impact. For this year as well as for next year. More so maybe in 2026 when the memberships really start to get to maybe the 150 million membership scale. In terms of the guidance, which was the last positive, very positive moving into the second or the last quarter of this year. Another 15% growth is expected and higher net additions versus this quarter. So this quarter was 5. They don't give an exact number for next quarter, but typically it's you expect somewhere in 7 to 8 million at least, given usually fourth quarter is the highest season in terms of seasonality. The only negative that we saw is that there's a slight drop in memberships in Latin America. By slight drop, I mean 70 or 80,000. So really almost flat. And this was mainly due to price increases in their larger markets in Latin, like Argentina as well as Mexico. But that being said, Latin American revenue still grew about 9% year on. In terms of the outlook, like I said, still fairly healthy outlook. Margins are expanding a little bit. Top line continues to grow, while the membership base also continues to expand. Overall good results, but right now based on valuations, we actually raised our target price by to $695, but we downgrade our rating from accumulate to neutral. Mainly because the stock price has gone up about 60% so far this year. Very significant increase. It's currently trading about 28 times forward PE. Which is about a 50% premium over its peer average of 17 times. So we just think that valuations are pretty full, which is why it's in the title. And that's really the only reason why we downgraded to neutral. The underlying business metrics continue to be very healthy and continues to grow very well. So that's all on Netflix. Move on to ASML. We're doing a Phillip on the ground, so we don't actually cover, and it's non-rated. They also had their third quarter earnings last week. ASML is a semicon equipment company. They have a market cap of about $330 billion US. Overall, for their results, it was actually fairly in line, slightly towards the higher end of their own guidance range, which is good. You can see, revenue is up 9%, PATMI is up 10%. The big knock was their net bookings, which is in bold in the second point, came in at only 2.6 billion euros, which is about 50% lower than what analysts were actually expecting. And the reason why this is important is because bookings are basically a, a future look into revenue for next year. Because the bookings right now is actually most likely will be converted, 9 to 12 months from now. And so that really wasn't a great sign, at least on the commentary outlook. There were a little bit higher inventory levels, mainly due to longer build times. While they also mentioned that they're seeing a slow recovery across a lot of the non-AI markets. So you see like mobile and PC, especially in the memory market, excluding high bandwidth memory and DDR5. So the main knock for ASML is the guidance was actually pretty good for the last quarter of this year. It's just the outlook for 2025 was a bit weaker than expected, a little bit more muted. They guided down revenue to the lower end of their range, 30 to 35 billion, which is still a 20+% year-on-year growth, which is still fairly good. Although they did say that they do expect less than 50 low NA shipments. One of the important things to note is that also because of the newish export restrictions to China from the Netherlands, which is where ASML is based. They expect Chinese revenue to basically now is about 40 plus 50% of total revenue. They expect this for 2025 to come down to about 20%. So seem about half of about 40% year-on-year decline just from China itself. So the idea is that a lot of the reasons why results for this year and last year have been pretty good is because a lot of the Chinese guys have been stockpiling ASML equipment. And this will basically hurt them in the future. So overall, earnings were good, but just forward guidance really a bit weaker than expected. A little bit more headwinds than expected, especially outside of ASML. So that's all for ASML. Move on to my next counter, which is TSMC. We're still doing a Phillip on the ground. We don't have any coverage, so it's non-rated. TSMC is the largest semicon foundry in the world, market cap about 100 plus billion US dollars, so fairly large. In terms of their results, they had a very strong set of results, both on the top line as well as bottom line. You see here, revenue is up 36%, PATMI up 51%. Margins, gross margins about 50% is well above guidance of 54.5%. So significant improvement there in terms of margins. For TSMC, more than half the revenue comes from HPC, which is their high performance compute. Essentially, a lot of the AI, most of your AI demand is there, and smartphones. If you combine both these segments, represents about 85% of total demand for TSMC. So the good thing for them is that they have significantly high margins, even though they had higher electricity prices, which raised a lot on their foundries. This is mainly due to increasing utilization rates and as well as some cost improvements. We do also think that they didn't mention this, but we do also think that there some price increases are already taking place, and that's why margins have expanded. Almost 3.5% more than what they guided. Secondly, TSMC is actually very buoyant, and they're very positive on AI demand. The main commentary is that they see AI as a very tangible ROI benefit, mainly because they continue to use it internally to improve their own processes and improve their own cost management. They do also expect the contribution from server AI to more than 3x this year, to represent about 15% of total revenue. So fairly significant revenue for this year. Obviously, this will increase again next year as demand continues to grow and as they continue to expand their capabilities, especially on the packaging side. So guidance for them, very, very positive. And you saw this in the share price performance. They're up quite significantly, I think 7 or 8% on the Friday session. For 2025, they do expect slightly higher capex, especially as they build out new fabs in Arizona as well as in Japan, and they actually have 3 fabs in US that they are starting to build. The Arizona fab is expected to begin volume production in early 2025. So this will be a bit of a dilutive to margins because typically as production begins, it's just higher upfront costs. While the ramp isn't really efficient yet, so it's just really negative on margins. At the same time, they expect higher electricity costs, especially in Taiwan. They mentioned that over the last 3 or 4 years, electricity costs have almost doubled. So it's weighing significantly on gross margins for them. Yeah, so overall for TSMC, a very good set of results. Very positive on outlook. They are the main, basically all the AI demand is flowing to them because they're the main foundry guys that make all the chips for everybody, for at least all the top AI players. And so it's just very positive commentary around that. You look at the chart here on the bottom right, essentially it's showing the last 12-month revenue for TSMC. You can see there's a significant improvement in terms of growth as well as the absolute number, which just goes to show that the significant increase in demand for AI, especially that's flowing through TSMC. Yeah, so that's all for TSMC. I'll move on to my next part, which is on the Max 7 monthly. Yeah, so we're just doing our typical September update. The Max 7 was up about 4%, so outpacing the S&P 500 and Nasdaq, which was up 2% and 2.5% respectively. Tesla was the biggest gainer, mainly because there's quite a bit of hype as a lead up towards their robotaxi event in early October. Funnily enough, since then, actually they've given back most of their share price gains. Yeah, the other biggest gainer was actually Meta, almost 10%. All Max 7 companies were positive for September, mainly thanks to a 50 basis point Fed rate cut. So it just boosted all of the growth stocks and a lot of big tech companies. Yeah, so in terms of individual news, there are two main things. The first one is actually a new antitrust trial against Alphabet by the DOJ. So now that they're continuing to target their advertising business. Previously, the first antitrust was against their search advertising. Now they're looking to divest Google Ad Manager, which essentially is their ad platform that most advertisers use. So essentially, what it seems that what they're really targeting right now is just the individual components of the advertising business to try to break it up as best as possible. We don't think that this would really that really is the extreme case. I'm not sure if that would happen because it seems a little bit much for I guess just a big tech company. It will be really unprecedented if that happens. Another thing, moving to Tesla, deliveries were a little bit shorter than expected, but still fairly positive compared to previous deliveries for this year. Starting to see a little bit of a turnaround. The deliveries were actually starting to grow again. It only missed estimates by about 1,000, so very minor miss. Another positive is that from China, deliveries were up 12% year on year, which is in kind of stark contrast to what the economy has been over there for the last 2 years. So a little bit of green shoots there. Although when you look at some of his competitors like BYD, they sold 1 million cars, 2.5 times more, and they're growing 38% year on year. So still kind of losing a little bit of market share to his competitors. The other thing was this We Robot event, which essentially it's his robotaxi event that was held in early October. The key thing is that they showcased their new CyberCab prototype, essentially at no steering wheel and no pedal, so it's going to be fully autonomous. The CyberCab is expected to cost slightly under $30,000 US, while the two other products, the RoboVan as well as the Optimus, Optimus will cost somewhere in the ballpark of $25,000 to $30,000 US. The key thing that they didn't really give a timeline on was a release of a anticipated lower cost model, which is dubbed the Model 2. So they didn't really make an announcement of that. So it kind of led investors to have more questions because the pathway to this mass robotaxi, I guess scale is still a little bit uncertain. At the same time, if they want to compete in the mass market, they can't do it unless they have a low cost vehicle. And that's really what's hindering volume production because the current Model 3 and Model Y, I think the Model 3 is starting at 40,000+. It's still more in your premium mass market. It's not really, so you don't really get that volume push unless you drop prices, and you can't drop prices unless you can manufacture cheaper. Yeah, so that was the reason why Tesla has actually sold off quite a bit since then. Yeah, so that's all for updates. Maybe I'll hand it over to Helena for Apple and Amazon. Thank you.
Thank you, John. Moving on to Apple. Okay, the first one, iPhone 16 lead time is actually below historical average. This is not any official numbers, this is just according to media reports. So they reported the US average lead time for iPhone 16 is 15.2 days compared to 25.7 days for iPhone 15 and 18 days for iPhone 14. And the same pattern is seen for international demand. Another interesting trend that they view is the lead time for the higher end, the Pro and Pro Max model is roughly the same compared to the basic iPhone and iPhone Plus model, which is a little bit unusual because usually the higher end model for the 14s and 15 series, they usually have longer lead time compared to the basic models. Another news, I guess, expected is they're seeing discount in China due to the soft demand. So this is actually ahead of the official launch. The online retailers in China, they're already reducing their price for iPhone's 16 series. The discount is almost up to 10%, offered on major platforms like Pinduoduo or Taobao. Well, we think assessing demand using lead time is not exactly fair because shorter lead time sometimes it can be due to a stronger supply. Because Apple this year they do plan to ship 90 million units globally in 2024, which is 10% up compared to last year's iPhone 15. So you can't really say that just because the shorter the below average leading time means that the demand is not good. But nonetheless, we remain rather cautious in the short term because due to intelligence staggered rollout, as well as the lack of major hardware changes. So their product sales still going to remain flat and China market continues to not do well. But however, we remain optimistic about the upgrade cycle once Apple Intelligence start getting traction in FY25 and 26. So overall, we maintain our neutral rating. Moving on to Amazon. Amazon's been introducing ad on Prime Video for the first time earlier this year. And they've already announced that they actually surpassed their target to secure $1.8 billion in ad spending commitment for its video streaming services. So right now it accounts for roughly only 4% of the total advertising revenue. But we think overall the advertising has been doing really good. Their growth stand out in the recent quarters compared to the overall retail growth, which is around 20% year on year in the last quarter. So we still view advertising as a major growth opportunity because it has the ability to expand alongside with the retail business. And Amazon, they do have a little bit of advantage because they have a lot of first-party data that they can use to leverage in order to deliver more targeted and efficient ads. So currently advertisement only contribute to less than 9% of their total revenue. So we think there's still a lot of area for growth. Other than that, Amazon's main growth driver, AWS, still remain intact. It's driven by the ongoing investment in AI and cloud infrastructure. So overall, we're maintaining a buy rating on the stock with a target price of $220. Now I pass my time to Ambrish to close out with Microsoft.
Thank you, Helena, and good morning, everyone. So for Microsoft, there was no major news in the month of September, just that it declared a quarterly dividend payment of about 83 cents, which was up 10% on a year-over-year basis. And also it announced a share buyback program of up to $60 billion US dollars. Meanwhile, in terms of its September ended quarterly results, it's expected to report that later this month, and with its total revenue to grow by about 14% on a year-over-year basis. And we believe that this would be continued to be driven by its strong demand for its cloud computing service, which is Azure, and it's expected to grow by about 30+% range in the September ended quarter, and mainly because of the shift in workloads from on-premise to the clouds. And as a result, we maintain our accumulate on Microsoft with a target price of $480. Next slide, please. So to conclude, for Magnificent 7, we maintain our overweight recommendation mainly because of the strong demand for digital advertising. So particularly like for Meta, the cost per 1,000 impressions, they were up by about 29% or 30% on a year-over-year basis in September. And also the cloud hyperscalers, they are still witnessing a strong demand for its GPU as a service. And also lastly, the EV demand, it's also started to pick up in China, mainly because of the stimulus. And so overall, we maintain a overweight recommendation on Magnificent 7. So that's all for me. I would now like to pass it on to Helena.
Okay, thank you, Ambrish. Move on to the S-REIT ETF. So the Lion Phillip Nickel AM trading Asia of Japan, and CSOP Edge S-REIT leader. So these are the three S-REIT ETF that were actually initiated earlier this year. So this is just a quick update. We kind of lumped the three of them together because their story is relatively the same. So we do anticipate dividend growth following it. So there has been no major changes in all the three ETFs, including addition and removal of any component. So the general trend that we're seeing is that DPU is decreasing due to the increased financing costs. So following the Federal Reserve's 50 basis point rate cut on 18 September, my team, the REIT analysts, they actually did a sensitivity analysis. So we kind of expect a 3% improvement in the ETF's DPU. So this is just a brief diagram of the difference between the ETFs. So there are actually 5 ETF listed on the SGX. So out of the 5 ETFs, there are only 2 that focus solely on Singapore ETF, which is the Lion Phillip and the CSOP. So for these 2, Lion Phillip is obviously a lot bigger. They have a much larger market cap compared to CSOP. But if you look at it, all the other stuff, the expense ratio, the dividend, the composition, it's pretty much similar between these 2. Actually, CSOP even have a slightly higher dividend yield compared to Lion Phillip, but CSOP is a much discounted price. So we do prefer CSOP especially if you're a dividend focused and you want to purchase the ETF at a lower price. So this is highly recommended. But if you don't want to focus only on the Singapore market, I guess you can consider Nikko AM. So Nikko AM, they actually focus on the Asia ex-Japan area. They have around 68% that focus on Singapore REIT. Okay, moving on to valuation. So we'll be using the same methodology for valuation, just as our initiation. So we use 2 different valuation methods. One, we use the dividend yield spread. The other, we use the PB ratio. So for the dividend yield spread, we'll be using the spread to 10-year bond. And the PB ratio, we're calculating the PB ratio using the weighted average of the PB of individual composition. So in the end, once we came up with the target price, we used the sensitivity analysis to apply 5%, 10% discount and premium to come up with a range. Then after that, the target price that we came out, we're using these 2 separate methods. We're taking a 50 and 50 weightage to come up with a final target price. So for Lion Phillip, we have 0.91. And for CSOP and Nikko AM, we have the same target price of 0.845 Singapore dollar. So that's all from me. I'll pass my time to Darren to talk about Keppel.
Yeah, thanks, Helena. Yeah, I'll talk about Keppel DC REIT. So for their third quarter business update, basically they had the key highlight for them was that they managed to continue the trend of exceptionally strong positive rental reversions. So in the second quarter, they had over 40% renewal. So in the third quarter, they also had another one. So this is quite significant, a co-location Singapore asset. Yeah, so just running through the results. Basically for the results, it was slightly better than our expectations because of the exceptionally strong rental reversions. But for gross revenue, they had some contribution from Tokyo Data Center 1 as well, the new acquisition, and that was also partially offset by the divestment of the IntelliCenter campus earlier this year. And for their Kwangtung Data Center, the rental income, the accounting treatment they do is basically they recognize revenue, but they will offset it under loss allowance inside property expenses. So basically, the impact will be gone really by the time it hits the MPI. Yeah, so as a result, we saw the MPI down, but the revenue is up almost 9%. Yep, and so other than that, for the positives, they still maintain a high portfolio occupancy. Yeah, right now it's about 97%. And this 40% reversions, we think it will likely continue because Singapore, it has limited supply and the demand is still very strong. And for 11.5% of the leases that expire in FY24, so a lot of it is in Singapore co-location assets, and 3% of it is in Australia, the God Hill data centers. Yeah, so that one, the reversions might not be as strong as the Singapore 40% ones, but we still expect positive rent reversions. And another positive is that their cost of debt, it improved from 2.5% to 2.3%. So that is mainly because they took up some loans the Japanese yen loans to fund the Tokyo data center acquisition, as well as the fact that they paid down some debt, the higher cost debt. So as a result, their gearing also rose almost 400 basis points to 39.7%. Right now, 79% of the debt is on fixed, and Keppel DC REIT, they usually forward hedge their foreign source income by about half a year to 1 year. So right now, most of the foreign source income is already substantially hedged. The negatives, as usual, for the past few quarters is the fact that the quantum data center, basically they're still not paying any rents. So over a year of rents are owed, about 26 million, and every quarter they are providing for about 5 to 6 million of losses. So the more this drags on, basically every quarter they'll keep incurring another, or rather they'll keep providing another 5 to 6 million every quarter. So year end, we think because of this, there will be a risk of asset devaluations at the quantum data centers because of the non-collection of the rents. Yeah, so for the outlook, we think rental reversions for the data center space will remain strong this year and next year. But for Singapore, we think it will be exceptionally strong. Perhaps even around these 40% levels going forward because of the limited supply, as well as a still very strong demand. And there's a lot of spillover demand also, like you see going to Malaysia and such. They're going to the region. And for the sector outlook growth, the data center space is still experiencing very significant growth globally due to the generative AI and digital transformation, cloud computing, big data, and such. Yeah, so with that, we upgrade to a neutral call. Before this, it was a 1.93 target price with a reduced call. And now we upgrade to a neutral call. Our estimates were revised, so we upgrade our DPU for FY 2024 by 5%. That's because we put in some higher, stronger rental reversions for Singapore, as well as some cheaper cost of debt. And we also lower our risk-free rate to 2.5%. So as a result, our target price it increased to $2.16. Yeah, but it's an accumulate call, still a neutral call still. And right now, Keppel DC REIT is paying a forward dividend yield of about 4.2%. Next year is 4.7%. FY25 forward yield of 4.7%. But one more thing that I would like to highlight for this is that this year they had the payment from DXC settlement sum, the DXC settlement. So it was about 11 million that they will distribute over the course of the year. So next year you have to, inside the numbers, you have to account for the fact that there will not be this 11 million. So yeah, you just adjust the numbers accordingly, which we did. Yeah, so the year-on-year growth next year might not be that strong despite the positive rental reversions, mainly because of this factor, the 11 million that will not be inside next year's financials, as even though there will be lower financing expenses, finance costs as well from the lower interest rates. Yeah. Yeah, that's all for Keppel DC. I'll move on to the REIT monthly. Yeah, so this REIT monthly, our title is we expect DPU to grow in 2025, even though interest rates have already been cut, mainly because of the fact that a lot of the REITs they still have about over 70% of the loans on fixed rates. Yeah, so this just share price performance of the REITs in September. So you see the whole index is up in September 2.5%. So it followed from the previous 2 months. So in total, it's up over 10% over the past 3 months. And year to date is still down 1.7%, but this is just a pure share price performance. If we include the dividends, it's up slightly 0.2% for the REIT index. Yep, and basically all subsectors were up last month. But since then, some of the REITs have came down, especially since the dividend yield also. I mean the risk-free rate, or rather the Singapore government savings bond yield and the Treasury bond yield also spiked. So that also affected some of the REITs. Yeah, I'll talk about that in the following slide. Next slide, please. Yep. So the dividend yield spread. So because of the share price performance, it jumped so much over the past few months. The forward dividend yield has fallen, and the dividend yield spread also has fallen, but but that's as of September. After September, like in October, it has risen, but because of that, the yield spread has fallen to about 3.1%. Going forward, we think the yield will start to come down for the 10-year Singapore government savings bond yield. Will come down in line with the Fed funds rate cuts. Yeah, so and we also expect the absolute number of dividend, the DPU payout next year to start to increase, like I mentioned, because of the lower interest rates. So as a result, we expect this 10-year dividend yield spread to continue to widen into next year. Yeah, next slide, please. Yeah, so for dividend yield, it's down because of the share price performance. Right now, it's about 5.8%. It's trading about 0.6 times below the historical average, or rather the 10-year average. And for price to NAV, because of the recent run-up, it's now at 0.96 times, and it's still trading below the historical, the 10-year average of about 1.03 times price to NAV. Yep, next slide, please. So our subsector preferences are still hospitality. Like we see in August, the hotel RevPAR has improved 1.5% year-on-year. So that follows a couple of months of a negative year-on-year growth. We think going forward, the hotel RevPAR, there is potential for it to grow low single digit for the rest of the year, because there are so many concerts as well as the F1 and such. You'll see next month's number. We think we'll still post some year-on-year growth because of high occupancy. But it seems like the hotel average daily room rate has already normalized. Yeah, so international visitor arrivals, we expect it to recover, the full year IVAs to recover to pre-COVID levels by next year. And right now, especially for the month of September, China is grew 60% year-on-year, but still below pre-COVID levels for September only. And RevPAR is already 19% above pre-COVID levels. Yep, and the improvement of digital arrivals will also will help to drive tenant sales. And next slide, please. So we also favor the REITs, the retail sector. Yeah, mainly because of the fact that we see a lot of the retail rental reversions being quite strong, like downtown malls, they're posting retail rental reversions of 20%, and suburban malls, they are posting reversions of about high single digits. So that is, we think you'll continue into next year. So that is why we like retail as well. Yeah, one more thing, because of the interest rate cuts, we also noticed that the transactions volume really picked up over the past few months. So there were some capital land transactions and Mapletree Industrial acquisition, yeah, like Ion and Life Funan and such. So the transaction volumes are really picking up. So we expect this to continue as well. Yeah, next slide, please. Yeah, so this is our coverage table. Everything here is updated except for Keppel DC REIT, because this was published before the results. So Keppel DC REIT is no longer reduced, it's now neutral as shown at the earlier slides. So now the target price is $2.16. Yeah, that's all for me. I hand over time to Meow Meow. Thanks.
Thank you, Darren. So we attended IPO roadshow for Goodwill Entertainment. Next slide, please. The company is started to complete the registration of its offering document on 25th October and officially start trading on 1st November. And Goodwill Entertainment operates 12 multi-entertainment concepts across Singapore, including karaoke facilities, performance house, and also dance clubs. Yeah, so they have a live house at Bugis, which is the picture on the left, and also Have Fun Karaoke is on the red bottom. Yeah, so the most profitable outlet differs every year, but the city outlets such as Bugis Plus and Cineleisure Orchard always outperform the suburban outlets such as Toa Payoh and Pasir Ris. And the company is valued at 18 million and has raised total 12 million, including 8.5 million new shares and also 3.5 million window shares, which result in 15% free floating shares. And the main source of revenue comes from three parts: rental of karaoke lounge, sales of F&B, and also private events. We do believe the valuation is pretty high, and its historical PE is around 25 times. And although revenue is on the upward trajectory post-COVID, that they managed to generate 23.9 million in 2023 and 23.2 million in 6 months 24. And but net profit in 2024 is not as promising as last year. It will be lower than 2023 level, even if we use the 3 months 24 profit and annualize it. Yeah, so not to mention, they have pretty substantial IPO expense in this financial year. And Goodwill Entertainment also plans to distribute dividend with payout ratio of 30% for FY24 and FY25. And in terms of IPO persist, they plan to use 25% for overseas expansion with a focus in Southeast Asia market, such as Malaysia and Thailand. And 20% will be used for acquisition, and 10% will be used for investment in existing infrastructure, such as their app and all other value-added products. And 20% will be retained for working capital, and another 25% will be used for expansion in Singapore market. And currently, the CEO, Phillip, is the largest shareholder with 71.8%. And the remaining 25.9% belongs to Mong Kim, which is a Singapore incorporated company involving the retail sales of motor vehicles. Yeah, that's all for me. I'll hand over to Zhang for technical plus.
Thanks, Mel. Good morning, everyone. I'll move on to the technicals. Next slide, please. Yeah. So first up, look at S&P 500. It continued to be very strong, closing at a Canada all-time high on Friday. Was up 0.8% on a weekly basis. So for looking at that, we are likely to see this trend of new highs continue going ahead. Their resistance at 5,870 to 5,950 area, or support is likely to be at 5,800 to 5,840. Next slide. Next one, look at the CSI 300. Currently, it's trading within a short-term downtrend channel in blue, as shown in the chart. Last week, we saw a retracement back to the 50% Fibonacci retracement level at around 3,800, and then we see a bounce on Friday. So with that, we're still likely to see some sort of consolidation ahead within this channel. Resistance likely to be at 3,970 to 4,100 area, or support is likely to be at 3,700 to 3,855 area. Next slide. Next one for Hang Seng Index, quite similar as well. Trading within this short-term downtrend channel in blue. Last week we also saw a retracement back to the 50% Fibonacci level at 20,100. It was also we feel a price gap over there as well. So with that, we are likely to see some sort of consolidation ahead as well. Resistance at 21,000 to about 21,600. Support at around 19,900 to about 20,500 area. Next slide. Next one, we have technical buy for iShares Semicon ETF at $239.80. Take profit levels at $266.50 and $271.35 respectively. Stop loss at $229. Last close was $229.36. So on Monday, the chart actually it showed a breakout of an ascending triangle with neckline resistance at $237. Coupled with the increasing momentum MACD, we thought that the price could hit higher to actually retest a previous high around $266 back in middle of July, as well as hit the projected target level close to $271. Next slide. Next one is a technical buy for Celsius at $34.82. Take profit levels at $41.80 and $48.60 respectively. Stop loss at $30.50. Last close was $33.85 on Friday. So looking at this chart, there was a breakout of a downwards resistance line since price put back since July, and then recently price action looking better with a recovery above the $31.70 support breakdown level, and then with increase in volume as well. So with the increasing momentum in MACD and the bullish divergence, we could see the price do a recovery towards these two profit levels, which were prior resistances. Next slide. So just to summarize the trades initiated for the Semicon ETF, it's hit our stop loss, so it's down 4.5%. For Celsius, it's currently in progress, currently down about 2.8%. So that's all from me. I have time to Paul to talk about Singapore weekly. Thanks.
Yeah, thanks, Zane. Thanks, Zane. Good afternoon or good morning, everyone. Yeah, so I'll just give some highlights of some of the key macro news that came out for Singapore last week. The main news was from SIA, so they gave some operational data. So for that, they mentioned the cargo carried was 14%. It's slightly lower, probably the slowest growth this year, but it's still higher than pre-pandemic, about 6-7%. This is positive. This is a positive. We use this data point to gauge how SETS is doing, because SETS is the company that handles the ground handling. So although it is slower, but it's still robust growth compared to pre-pandemic. But we just need to monitor the pace of slowdown for cargo. The other data point SIA mentioned was passenger. So for passengers, the capacity is 14, but the demand is 12. So how we use this data point is that firstly, there's a healthy expansion in capacity. So when capacity grows, it's so strongly, it's actually positive for companies like SIA Engineering and also ST Engineering, because when capacity grows, then there's need for more maintenance work and so forth. Again, this is compared to pre-pandemic, about 6% growth. The demand is still generally healthy, but for us, it's not just the demand, it's just that the capacity is outgrowing demand. So what we view this is that it will impact yields or impact the margins, because pricing will come down when we mention about yield refers to pricing. Some negative data points was export. So exports is starting to slow in Singapore. Again, this is just one data point, but it's starting to slow, and we see a similar weakness in Taiwan and Korea. If you recall, last week we also discussed that exports is also starting to slow. Our view, like we highlighted before, is that there's a bit of stocking up in US, especially ahead of the elections, in view of the threat of a Trump trade tariffs. So I think that's our general view why exports is a bit stronger in the last 2-3 months. In property news, the September numbers was exceptionally strong. It was up about 85%. We probably should see October also very strong based on the recent launches. But for the third quarter, it's still down 41%. In China, there was a slew of economic data. There's lots of it. There's fixed asset investment loans. But if you look at some of the key ones that we look at, like property, we're starting to see some stability. Property sales in China is still slowing down about 11% in terms of square feet, but at least the pace of slowdown is the weakest in 16 months. Retail sales also starting to perk up a bit. Again, the fastest in 4 months. But again, this is still just one data point we need to see. But at least there seems to be some bottoming out in the Chinese data for now. The US remains resilient when we look at consumer sales. We like to use this retail sales, excluding motor vehicles, as volatile. We also exclude gas sales because that is very dependent on oil prices. So when we strip out, we try to get a clean number of retail sales. It's up about 3.7. So it's still very strong. I think the retail consumer spending in the US is still resilient, if not robust, I guess. Next slide. We move on to our tactical view. So the big news was ASML. So the share price was down, I think, like John mentioned, the share price was down 20%. The concerns that the market had was the bookings was weaker than expected, and also their 2025 guidance. But for us, we don't see any contraction. I mean, our lens is using Franken, because Franken is a major customer for Franken. So from a lens of a supplier, the 2025 revenue is still actually growing. So ASML is still guiding a 16% growth in revenue. And actually the bookings, although disappointing on an annualized basis, is still growing 22%. And the other benefit Franken has is that companies like ASML is actually outsourcing more into Southeast Asia, because I think Europe, they are facing capacity constraints, and also a bit of labor issues. So that's why they are trying to outsource more from Southeast Asia. But I think the main concern for ASML is really the high end of their products. They are high-end lithography. So I think high-end usage now, Samsung has issues. Intel also has issues. So the only one buying such high-end equipment is probably TSMC. of course, they're going to bugging it down, and the only use is for AI. So I think it's more an issue of getting a very high-end lithography, and of course, China, after the huge stocking up, they are starting to normalize. So I think this is so we think for this sector, it will still grow, but then just to taper down their expectations. And there's a bit of a near-term inventory concerns, but I think the growth is still generally still strong. For at least if you're a ASML supplier like Franken. For AI, just a reminder, so looking at TSMC's results, the AI demand is tripled. So I think AI demand is still stellar. I think just 2 weeks ago, we didn't mention it because Jensen also said that their new Grace Blackwell chip, the H200, actually the demand is basically said the demand is insane. So we do see many corporates other than the big tech names, your hyperscalers like Amazon, other companies joining the bandwagon, like Tesla, it has a GPU cluster of 100,000 GPUs. Oracle also building another cluster. So there are many such clusters, and what is happening behind it is generally there's an arms race. So everyone is trying to rush and build up as much as possible. I guess the ultimate aim is to get some AGI or artificial general intelligence. I mean, that's the general view. The rate of change in AI development is tremendous. I think the most important is, of course, always the rate of change. So if you check the news, I think OpenAI released, I think 1 week ago, this thing called Strawberry 01, which is instead of training the AI on the data, you actually train on the output. So it takes another, I guess it continues to expand the whole generative AI a model, and this will demand more and more GPUs. So the demand for AI remains tremendously strong. The other thing is for the events, the main one, I think 24th October, we'll have Tesla and Keppel's results. Corporate insights. So for this week, we will have Core. We also have Capital Land as an Escort, but I think that is mainly for our trading reps or sales staff, salespeople. And then the rest we have Propnex, Manulife. No, feel free to join in. It's open to everyone, except the TR only session. Next slide. If I move on to just illustration of what we just said. So if you look at this, the cargo part. So cargo, which is Changi Cargo or SIA Cargo, it accelerated because of, I guess, in part because of the strong export sector and also because of the whole Red Sea issue. The growth is still there. It might be tapering off a bit, but it's still far stronger than the pre-pandemic 2018, 2019 levels. So the one on the right is just to show, if you want to illustrate yield pressure or pricing pressure, is that in early 23, you can see the demand for passengers growth was outpacing the red line, which is capacity. But right now, capacity is coming on stream, not to mention competitors. So that is, we think, I think that's why we have a reduced view for SIA, because we just worried the margins will be under pressure. Next slide. The other thing is just to give you a sense of the property sales. So this is by square feet. So it continues to be down. I mean, the blue line here continues to I don't know, to go to new lows. I probably can't go any lower. There's not much data left. But you can see that there is some stability. It's hard to see because the chart is steep, but on the year-on-year, it's still slow. It's starting to slow down. The one on the right is just China retailers. It's a very noisy chart because pandemic, then no pandemic, on off. But if you look at the end point, it's about 2%, 2.7% compared to September pre-pandemic. So China definitely slowed down, but I think the pace is starting to stabilize at least. Next slide. So there's two more last ones. So this is just to show that the US consumer, I think really no risk of any recession. I think the retail sales is still stable. You look at the blue line, and then the only thing is the inventory has started to stock up. If you look at the right here, so that's why we think the inventory is stocking up and helping the export sector. You can see the beige color. There's a sudden, not a spike, but at least it's growing above trend. Next slide. So this is just the ASML now. You look at bookings. So for bookings, it peaked in 2022 about 30 billion, but it's starting to grow back again. But I think we probably won't get those kind of huge surge in bookings. But I think there will still be growth as they are guiding for growth about 16% in 2025. So this one on the right just to show that the inventory might be up a bit. So that will be the commentary we probably want to watch from Franken, whether is the customers having too much inventory and the orders might just slow down a little bit. Yeah. Okay, I think that's it. I think you can move on to Q&A. Thanks, Evan.
Yeah. Maybe I'll start first. See quite a few good questions. Okay, so the first one here, were there any clues from BAC's results that could show why Warren Buffett sold? No, I don't think so. It's quite interesting because it's they did pretty well. They're also above estimates, and their fourth quarter is going to be quite good if they meet all their guidance and if they, I guess, live up to the expectations of what they're doing. But they really have proven, in the third quarter that what they have said in the second quarter has come true, right? Mainly being that their net interest income has sort of bottomed in the second quarter. So we have seen an increase in the third quarter. At least, if you look at it year on year, quarter on quarter, right? And also their expenses are very well controlled. Provisions have also not really increased much. So I think all the signs have shown, and of course the biggest positive for Bank of America being that they are investment banking and and the asset management sector is doing well, right? Which is to be expected. Excuse me. Yeah. So these factors are proving to a rather positive fourth quarter results for Bank of America. So it's quite interesting why he's selling. But there are several reasons why I think that he's selling. Firstly, he wants to maybe get it below that 10% threshold so that he doesn't have to do any of the regulatory filings if he were to sell the stock, right? And then secondly, it could also be some form of profit taking. And if you look at his portfolio, you can also see that he doesn't really. If you look at the top 3 banks, right, or the top 4 banks, he's still quite heavy in Bank of America, even though he has sold quite a bit. Yeah, so I think it really might be some form of profit taking for him as well. Okay, second question is investment banking expected to remain strong in the upcoming quarters for the US banks? Yep. Next quarter will be another good quarter for the US banks. So investment banking is continuingly showing its growth, and mainly from the advisory fees which have been increasing, and also of course the overall activity has been good for investment banking. And last but not least, is coming off a pretty low base in 2023. So I think that the banks will continue to have quite good earnings for the investment banking. And if you look at the other side as well, it's the fee income, other fee income, which is like the asset management, wealth management side, will also continue to be strong, as the interest rates start to drop. So they will probably be able to focus more on this and also get a higher margins when they do sell their products. And I think let me just jump all the way straight down. I saw a question asking what is my preferred bank, US bank. So I answered it earlier, but I'll just reiterate it again, being that our favorite US bank, or our pick among the 3 that we cover, would be Bank of America, mainly due to a very positive fourth quarter. So we do see a huge jump up in their earnings because they did quite badly the previous year, previous fourth quarter in 2023. So we are expecting a 30% increase. And also, another reason why Bank of America stands out from the rest is that they have, at least they are the only ones that have mentioned, that they have this $20 billion of fixed assets which are going to reprice in the coming quarters. So that's one of the reasons why we believe that their net interest income will also grow. So next quarter, I think the net interest income could possibly see an improvement year on year. Quarter on quarter, I think it's quite assured that we should see an improvement. But year on year, we could actually see an improvement in net interest income. And of course, they also focus very heavily on their fee income or non-interest income side, which is their investment banking and then their asset management, wealth management side. So that should see another double-digit increase. And furthermore, their expenses have been well controlled. So we would see that there would be a big jump up in earnings for Bank of America going into the fourth quarter of this year. So I've answered that one. So let me go back to the queue of questions again. Do commercial real estate make up a significant portion of US bank provisions apart from credit card loans? Yeah, so they are the second, I think it's the second largest apart from credit card loans, but it ranges, across the banks. So it's like 10 to 20+%. Yeah. So, but I think the main point for the commercial real estate is that they are controlling it very well. They have sort of lowered it quite a bit as well, the US banks, so they're not really focusing so much on this commercial real estate as much as they did before. And then they're also trying to cut down on the provisions and allowances for this sector. But what we're seeing now is that there is an uptick in the credit card sector. So it's like always when you try to fix one problem and then the other one goes back up again. So now credit card is starting to inch up, which is what is causing the provisions in some of the banks to increase, which is the credit card debt, right? And the credit card bad debt, basically the allowances and provisions, net charge-offs as well. So that's another thing that they will probably need to cut back down. But if they do cut that down, then we could see loans growth slowing down, because what is driving loans growth now is the credit card sector for almost all the banks. Yeah, credit cards are actually driving loans growth. Okay, so this one is a very good, interesting question. If I want to get exposure to investment banking, should I go for Goldman and Morgan Stanley or Bank of America, JP Morgan, and Wells Fargo? Yeah, if you really only solely want to go for investment banking, right, and their brokerage, their trading side, then yeah, I would say Goldman and Morgan Stanley, they concentrate heavily on the investment banking, brokerage, trading activities. So if you feel that the investment banking would be the way, and you don't really want to have exposure to the normal side of a bank, which is like the net interest income or even the fee income, then I would say yeah, Goldman and Morgan Stanley. But if you're looking to diversify a bit more, then I would say JP Morgan is the next best option amongst the three, because they are still, and they are currently the largest investment banking company in the US, right? So although the other two concentrate heavily, but JP Morgan is very heavy in the investment banking, but also into everything else, right? Because they are of their size, right? So they can diversify. So they are heavily into net interest income, as well as into their fees and asset management. Yep. So the next best option, if you want to diversify slightly, would be JP Morgan. I think there's a few more questions. Let me just go through. I saw one on Singapore, I think. Oh, sorry, I heard the thing jump. Oh, okay. What's the outlook on Singapore banks, especially on third quarter earnings, net interest income, net interest margins, and dividend yields? Very good question. Net interest income, net interest margins, I think they will probably take a hit, right? It's not going to, it's going to be a little bit worse off compared year on year, especially even quarter on quarter, definitely will be down. Year on year, I think we will probably see it down as well, mainly due to the rate cuts that have kicked in. So I think this is the first quarter in the third quarter where we will see the impact of the rate cuts and how it's affecting the Singapore banks. So moving from US to Singapore banks, right? Singapore banks, but one good thing about Singapore banks is that they're able to protect their net interest margins by being able to reprice a lot of the excess funds, excess deposits into higher interest yielding securities or assets. So that's how they're able to protect their net interest margins. All three banks are doing the same thing, but how much they're doing it, we can't really tell. I think only DBS is able to say that, okay, we can protect the NIMs all the way until the second half of next year, right? Because they are able to sort of refinance a lot of these excess deposits that they have. But then, of course, there will come a time where it will start to fall off, and then they have to reprice it slightly lower than what they got it at the previous year. So then we'll see that drop off in the net interest margins. But going forward into the third quarter and also into the fourth quarter, I think we're expecting NIMs to be pretty flat. It might dip a few basis points here and there. But I think net interest income similarly should also be down, maybe a low single digit kind of percentage. But what would then bring up the earnings for the banks wouldn't be the net interest income anymore. That story is sort of past. Now would be the fee income. So the Singapore banks are very focused heavily into shifting a lot of their focus into their fee income. So now they are concentrating on trying to make as much money as they can from the current AUM that they have. All three banks have grown their AUM very well, right? And I think a lot of it was, a lot of the customers were just putting it into fixed deposits. So that's why they can grow the AUM so fast, so large. So now they're trying to convert all these fixed deposits into wealth management products, investment products. And this is what is going to grow their fee income, or say their fee income, which is why we are looking at probably a possible double-digit growth again for fee income in the third quarter and into the fourth quarter. Yeah, and then that's how we're seeing that they'll be growing earnings. And consequently, once they grow earnings, the other two banks, OCBC and UOB, have stuck to this 50% dividend payout ratio. So we should see that their net dividend will increase because if earnings go up, then dividends will also increase because they're paying 50%, right? So we could see an increase in the dividends and as similarly the dividend yields for these two banks. But for DBS, it's a different story. They are not really sticking to any dividend payout ratio. They made sort of a pause in the second quarter because they didn't want to take in the CEO's word, right? They didn't want to take the limelight away from the handover to the new CEO. So they were saying, okay, we won't increase dividends this quarter. We'll hopefully see a increase, no matter how large or small, in the third quarter for DBS. So I'm hoping that will come in for DBS going into the third quarter of the year. How do we foresee loans growth? Example, home buyers, SMEs, to outweigh downsides on NIM and net interest income for the Singapore banks. Yeah, so loans growth is interesting because we have already seen it increase, right? Based on the MAS statistics data that we have, right? Before, like the 2 months before the rate cuts, loans actually rose, right? Low single digit, I think hovering around 2%, right? And it's interesting because why wouldn't they hold off until the rate cuts come in and then they can get the loans at a cheaper price? So that I can't really explain. Maybe they just waited too long. But what we are seeing is that loans growth will pick back up, definitely. And whether or not it will outweigh the downsides, I think it will be more of a balance where now the banks are saying that, okay, we don't really need to push for loans as much because the yields aren't really high and there's also not much demand, right? But they still have the capacity to grow loans, and they're still looking at a low single digit for FY24. And I think it will just it won't fully outweigh the sort of the downside in the net interest income and net interest margins. So we should still see a slight decline in net interest income. But as I said earlier, right, the net interest income is no longer the main story for the banks, right? They are now growing their fee income, non-interest income for the banks to manage to at least continually seeing some green or positive in their earnings year on year. So I think that will be the key factor which we have to look out for. Yeah, loans growth will just be a very slow, stable, steady increase for the banks, which will offset some of that net interest margin decline. Yeah. Okay, I think that is all for me. Let me hand it over to the rest of my colleagues. Thank you.
Yeah, thanks, Glenn. Let me run through a few questions on my end first. There's a question here on Netflix. Hi, Jonathan. Are we seeing near the end for Netflix membership growth? I recall they will stop disclosing subscriber additions starting Q1 2025. Yeah, so I don't think that will be the case. I think it's just very difficult to track because as they start adding more like different tier lists, then it's not really comparing apples to apples because like I said just now in the slides, for your ads memberships that are growing way faster. And at the same time, they only have like 12 countries where they are having this basic ads membership. So I think just because it's getting a bit too complicated and convoluted to actually measure accurate membership growth, that's why they decided just not to even put it out there. And instead they'll focus on just your revenue growth as well as margins, which would be a bit cleaner, I think, for investors. But they also did say that they will update the numbers in terms of memberships and ARPU and all that on an as-is basis, whenever there are any milestones hit or whenever they feel a need to disclose it. So it's kind of just giving them a bit of downside protection, basically. Yeah. Hope that helps. But in summary, no, I think there's still a lot of growth left. Obviously, they're very under-penetrated in most countries because what they're actually competing with is traditional TV time and traditional entertainment. So right now they're still relatively like 10% market share, at least in the US. So there's a lot more room to run. Yeah. Hope that helps to clarify a little bit. Overall, the business model is still pretty good. Another question here, John, ASML, you shared about their slow recovery impact of memory chips pertaining to PCs. So your comments on this effects on Dell, Micron, and yeah. So essentially, I don't think there'd be that significant impact to some of the IDMs as well as your PC chip makers. I think it's just expectations were probably a bit too high. At the same time, a lot of these IDMs and AMD included, utilization for at least for IDMs, the utilization rate is still not at its peak, so they don't really need any more equipment per se. I mean, if you step back and take a look at it. So yeah, at the same time, most of these companies haven't really given a lot of indication about 2025 guidance, but likelihood is that you would expect revenue growth to still be fairly good, just tempered down a little bit. Just not not in your 35-40% range, just a little bit less. Yeah, sorry. That's my best answer to that. Slower, more gradual recovery, but still a recovery. There's another question here. Do you see nuclear energy stocks as good buys on surging electricity demand on AI? Yeah, I can't really give you a very good answer on this. Obviously, the big news is just a lot of the big tech CEOs are talking about it and ganging up on it. I'm not sure if I'm not a scientist, but I'm not sure if nuclear energy will be stable enough, and if you don't have any government support, then that'd be quite difficult because it's nuclear energy. I think what's more likely to do well is it will probably be your clean energy, because there's no doubt that energy costs will continue to rise, and a lot of the locations where data centers are at are usually in the middle of nowhere, where sometimes electricity costs are higher, and maybe are not as stable, so that presents quite a big opportunity for clean energy to provide a more steady source of energy potentially. Clean energy, like solar, wind, and so on. Another question here: do you see Max 7 being a laggard compared to the Dow, S&P, and Russell for the rest of the year? Max 7 has been sideways since the rate cut. Yeah, actually, Max 7 has been sideways since the third quarter. I think for the third quarter, they're only up like 2%. They haven't really gone any. I think we could see a little bit of choppiness throughout this earnings season, but I think my best guess is that they'll finish the year strong. I think a little bit more positive on EVs, a little bit more positive on you still have your AI, your digital advertising. So generally, and generally the fourth quarter is a good quarter for most of big tech. Yeah, so I would assume that they will no longer be a laggard that they've been over the last 3 months. Another question here. Maybe I'll take a couple more questions or 3 more questions before I hand it over. What to expect from Tesla results this week? Honestly, it will just be on the margins, I think, because your delivery numbers are out, so you can kind of calculate roughly your revenue. We're just not sure about margins, which took a beat last quarter. They just got beat down really heavily. That's because of pricing. When you look at, I believe earnings last quarter was down like 50+%. Yeah, so I think the key will be there to see if there's any improvement on that end, especially on the margin front. I would still expect a little bit of weakness for Tesla. I mean, their core EV business is still not really covering that well. There's a sorry, let's go to the bottom. Yeah, there's a couple more questions on the semicons. I'll take that before I hand it over. Hi, John. Amongst Lam Research, Applied Materials, KLA, and Texas Instruments, which company has equipment with closest similarities to ASML in terms of cutting-edge technology for equipment makers? Which companies rank the highest to lowest after ASML? After ASML, I think it'll be Applied, and then it'll be Lam, and then KLA. Texas doesn't really. They do mainly like analog products. So I don't think Texas Instrument would be a good like you wouldn't really lump it into the whole equipment maker category, I think. Yeah, but it's actually the ASML applied materials and then especially in terms of cutting edge technology. Yeah, there's one more question I saw here. Okay, I'll take this one and now. Hi, Jonathan again. NVIDIA has about a year of cutting edge advantage over their nearest competitor, AMD. But Blackwell chips suffered some issues. How long ahead is their estimated advantage over their nearest competitor now? NVIDIA gross margin will likely suffer once competition heats up even faster. What's your view on this? Okay, so this is the first part. We still think that at least a year ahead. I think when you look at the AMD, they launched a new MI325X last week, a couple weeks ago. Essentially, when you take a look at some of the specs, they're really only on par or slightly better than NVIDIA's Hopper H200 chips, which has been around for pretty much a year. And then with Blackwell's only been delayed maybe like a quarter or less than a quarter. So we still think at least a year ahead in terms of maybe a year and a half, because Blackwell is significantly better than Hopper. And we're not sure if the new not MI325, but next year's MI350 will be significantly better than MI325. Yeah. So we don't think there's really that much competition. I mean, like 90% market share. So they still have a lot of pricing power, and margins we think will still be fairly healthy. The last part of this question is lastly, general and EVs chips seem to have oversupply based on what ASML mentioned. Do you think this oversupply is going to break the tech market in the middle terms? I think in general, no. I think it's just like they keep saying, it's just slow recovery. It's something that we've been posturing towards for quite a while. We never thought that the recovery outside AI would be that significant. On the EV front, especially because demand is weakening and they have had so many, like there's been so much production on EVs, right? And they're just sitting on the lots now and not being sold. So they've got a lot of inventory built up and a lot of inventory that is gone into, that is on hand for EV manufacturers as they also slow down manufacturing because they can't sell all their cars. So it's just kind of a supply chain effect there. And then in general, like the PC market and all that, we didn't think AI would be such a huge game changer that everybody will start buying these AI PCs and all that. And even smartphones, right? We thought it was more of a gradual thing to begin with. So for us, it's no real surprise there. Yeah. I hope that helped to answer questions. Hand it back to the rest of my colleagues to take on the rest. Thank you.
I guess I'll take the iPhone question. So is iPhone 16 sales better than feared? Sales was up 20% in China. First, it's not really formal numbers. So usually sometimes there has been cases where such research number is not so accurate. So the last time before the earning came out, they were saying the China sales were actually down for 20%. But actually it came out, it was basically flat. So we're not really sure the credibility of such numbers. So if 20% were really true, it's not expected. I guess one of the reasons that it could be the sales would be strong is that actually Apple, when they launched the iPhone 16, they launched it at exactly the same price as iPhone 15. So that's like your research and all the technology that you have over such a long period packed into a new device, and you're basically charging zero premium. So that kind of pushes people to purchase the new model. But it works on both sides, right? So because more people purchase the new model, it's going to eat in the sales of the older model. So if you look at the overall iPhone unit sales, it actually dropped 2% year on year during the same period because of this decreased sale of the older models and also increased competition from Huawei. So overall, I'll stand for iPhone in China still remain flat, especially because we think the upgrade cycle in China is even going to be later than the other regions because the rollout of the Apple Intelligence in China is going to be much later. They have not yet passed the China regulation yet, and Apple indicated that when they first roll out the Apple Intelligence, it will only be in the English version. So the Chinese version will have to wait. So definitely not going to be in the short term. I hope that answers your question. I'll pass my time to, sorry, just now, who did I interrupt?
Oh, yeah. I'll take the questions. Thanks. Thanks for your questions on WeHer and Centurion. So I'll take the first question. What is my view on WeHer, any target price? So we don't actually cover WeHer, but I'll just share my views. So WeHer is in the construction and worker dormitory, and also a bit of a student accoms business. Construction makes up about 50% of their revenue. Then for worker accoms, it makes up about 25% of their revenue. So my thoughts is that of course from the strong upcoming demand next year from the building of the Terminal 5 and IR, we do feel that construction in general will do well. So this will definitely benefit WeHer. And they currently have around 16,000 beds in Tuas dormitory. And the worker accoms there itself has 98% occupancy rate, which is a very strong occupancy rate. And next year, they are actually building one more worker accommodation in Pioneer Lodge. That one will have 11,000 beds. And it is expected to be partially operational by 1Q 2025 next year, and fully operational by the end of next year. And for context, Centurion, which is the larger worker accoms operator, has around 32,000 beds. So these upcoming worker accommodations by WeHer will definitely put them in a very good position to take in the shortage of worker accoms bed currently within the scene in Singapore. So we do feel that this will be a very strong catalyst for WeHer. Next question. Hi, there was speculation for WeHer sale of student accoms. Is there such a possibility for Centurion that can unlock further value in the stock? Yeah, so WeHer did announce last week, 17th October, that they are in the early stage of discussion to sell its student accoms business in Australia. So this has pumped up the share price by quite a bit. And your question is whether there's possibility for Centurion to do the same also, to unlock value. So currently, my stance is that Centurion, there's some catalyst for the share price. Currently, I feel that the catalyst is more of a very strong recurring rental revenue from worker accounts because of the shortage of beds, as well as a very strong rental revenue from the student accounts portion because there's a shortage of student accounts in UK and Australia. And the other catalyst is that because of the drop in interest rates, their interest expense will drop as well. So we think that this will also further push up their earnings. Of course, if there will be a small chance that they say they might sell their student accommodations, but we feel that we shouldn't base our analysis on this kind of speculative kind of news. And currently our target price for Centurion is still the same at 90 cents, and we feel that because of the strong catalyst and potential strong upcoming earnings, there is still room for growth for Centurion. Thanks. I'll hand over the time to my other colleagues.
Yeah, thanks, Iqbal. Let me try to answer some. What do you expect of Sanders and Mapletree Industrial's upcoming results? Yeah, so for me, I expect the DPU to remain relatively flat, actually decrease a little bit if you do not account for some of the divestment, distribution of previous divestment gains. So yeah, basically that's the DPU expectations. But for rental reversions, I think across the board, like business parks, data centers also, the rental reversions I think will likely drop to mid-single digits. Yeah, that's my expectations. Can we expect a bounce for China segment MLT and MPAC upcoming results this week? Yeah, I don't think the impact from the China stimulus will be so fast, if any. So personally, I don't think there will be much difference in like the sentiment for China, especially in the third quarter for MLT and MPAC. Yeah, any improvements will likely take some time and maybe only in 2025 or even 2026. Yeah, so the upcoming results, I don't think will have a strong bounce for the China segment in both REITs. With regards to Mapletree Industrial, is the US industrial segment doing well? Is occupancy and rental reversion good? Yeah, so occupancy 89, 87%, 88%, yeah. Rental reversions also single digits. So how many percent of the portfolio does US industrial segment make up? 46%. Yeah, rental reversions for US data center, I think will likely be around the mid to high single digit levels. Why is Keppel DC able to command such strong 40% rental reversion? Seriously, but yeah, that's mainly only for Singapore assets actually. Because a lot of it is more demand driven than supply driven. It's more demand driven because of the limited supply. So basically like how much you can squeeze from the tenant. So that is our house view. Yeah, so that's why they can command this strong 40% rental reversion, mainly because it's very supply constrained, like very limited supply upcoming. ASML REIT seems to be lagging in price growth. Any opinion on this? Yeah, actually, I so don't really have much opinion. We'll tune into their results. And we'll give some update after the results. Yeah, but I think it's quite lagged because some of the reasons I think it's because rental reversions are starting to significantly slow from the double-digit growth that we've seen previously. So I think that's one of the reasons also that the price might have been a little bit weaker. Yeah. What is the outlook on Keppel DC REIT? Do you expect DP to grow up? And yeah, so I mentioned in the presentation earlier, and there's another follow-up also on Keppel DC asking to explain the 11 million effect on the Keppel DC REIT next year. Yeah, so basically, if you remember at the start of the first quarter this year, there was this DXC settlement. They had a dispute with DXC previously, and eventually they settled out of court, and as a result, DXC will pay Keppel DC 13.3 billion. But if you minus all the expenses and whatnot, and all this GST or whatever costs, associated costs, the result will be about 11.2 million. So this 11.2 million will be spread evenly across FY 2024's distributable income. So basically in FY 25, there will not be this 11 million additional capital top up per se. Yeah. So definitely the distributed income just based on this year you have a positive 11 million effect. Next year you have the absence of the 11 million effect. So any DPU growth will definitely come organically next year. So yeah, that is the explanation of the 11 million. And for our outlook, we are still forecasting some positive rent reversions and DPU growth next year because of the lower interest expense base from low interest rates, as well as the very strong positive rental reversions in Singapore for their co-location renewals especially. Yeah, another one is DRCU. It's not moving, in fact slightly going the opposite direction during this whole rally. DRCU is a digital core REIT. The investment parameters are also better than Keppel DC. What's holding up here, and any forward headwinds? Yeah, so for digital core REIT, 1st October they had 2 LA properties that the lease expired. So basically they'll be taking over. So these results we will have some updates on that, like whether it's been leased or not. Yeah, but basically they've taken back these 2 significant leases on their 2 LA properties. So that is also that will definitely increase our vacancy. And that is I think one of the headwinds why the digital core REIT, the share price also didn't really rally as much as Keppel DC. Yeah, okay, I think that's all this question. I'll hand over to Paul maybe. Yeah, thanks.
Yeah, thanks. So I answered as much as I could by typing. So so sorry for those. I just have to type the answer. There's no time. But any reason for the shipping sector up today? Costco, Samudra, Seatrium, Pacific. Any link? Actually, freight rates have actually down. I was just double checking. It's still container freight rates are from the peak is down almost 40%. The peak was in August. Year on year is still good. I mean, it's like a year on year is still up triple, but I think container risks continue to slide on a weekly basis. So I'm actually not particularly sure. There was another question on the whole Middle East tensions. I think the only thing we can say is if these tensions, I mean, touch wood, do happen, then I guess it's always best to just hedge out your portfolio with some oil and gas stocks or oil and gas exposure. So in the event, touch wood, there's something negative happens and oil price suddenly spike overnight, at least you have some hedge inside your portfolio. And on these stocks, like we cover, Pacific Radiance is also running on its own. That there's earnings growth, regardless whether there's a Middle East conflict or not. So, but there's no news. I think I don't see any. Actually, it's actually bad news. Yeah, there's only for container freights. Yeah. Does ASML lower bookings affect Franken? Yes, it will in the longer term, but on the annualized basis, that means if you take the last 12 months bookings versus previous 12 months, it's still up. Their bookings is about 30 over billion. So that I think for the whole of next year, no issue. Of course, beyond that, it could be softer. But for the next 12, 18 months, I don't think ASML will cause a drag to Franken's revenue, because I think that you have these two tailwind, because the bookings is ample and they're also outsourcing more. So I don't think it will be a negative for Franken the next 12, 18 months. I mean, yeah, it will be a drag. Oh, okay. What's your favorite? Going forward, what's your view on Propnex? Can they maintain good dividend payout in coming quarters? Yeah. We still think they will try to sustain the 6% yield. I think that they never explicitly mentioned, but I think if you meet management, they've always looked at yield rather than just payout. So their payout can be more than 50, it can be even 100%. And like we highlighted, next year is their 20. I hope I'm get this right, as a 25th anniversary. So they should expect some special dividends even then. And with the new property sales picking up, that we think is a positive. All this needs momentum. I think, like we highlighted before, when one project does well, it will cause a lot of buzz and momentum for the following projects. And when new projects are lifted, the prices go up, it will also resuscitate the whole resale market at the private level. So new launches has there's a positive spiral effect. I mean, upward spiral. I mean, not downward spiral. There's a positive momentum when the new positive launcher. It will push up volumes for resale too, because there's a new benchmark pricing. Then so all these new launches that you see is actually positive, not just for private new launch, but also for resale. And you're coming off a low base. I didn't show the chart, but the new low home sales is about 4,000. Even during right now, the average is 11,000. Even during the worst of times when TDSR was announced, it was still hovering around 6,000. So naturally, the home sales should actually pick up strongly to even if not 4, at least 5,000. So there should be a strong rebound coming up for new home sales compared to historical. So if you assume a base level demand of 6,000, we're now running at 4,000. There should be a pickup in new home sales. But of course, it's hard to say that the last few months because it keeps on dropping. But I think at least we now begin to see some visibility there. So it should be positive for Propnex. What's your favorite pick in construction? What's Pan United's financial now? Is it undervalued? Yeah. So for us, we always bought the building materials because we wanted the lower beta way to play. So we always like BRC Asia, Pan United, and like my colleague Yip Ban just mentioned the DOMs. So we were virtually buying the infrastructure behind the whole construction rather than the construction players, because that has been, as those who follow the construction, is very hazardous to pick a construction stock. But others maybe could be like Tiong Boon. They are not a pure construction player, but they're also around the construction sector as a whole. Like the infrastructure, the pick and shovels are, I mean, lack of better word. That's how we buy rather than pick actual winners. So that's how we there's another few that slip our mind, but that's how we look at it. Yeah, but like we mentioned, yeah, I think construction next 2 years will be very strong. Any comments on Jaffa most recent acceptance offer? Does outcome likely lead to offer to relook higher offer and such? Usually there is, after you do this, usually I don't have the exact number, but usually 6 months or 12 months before you can do another offer. I don't have the exact provisions, but usually if you look like GOs or takeovers, usually there's usually a 1 year grace period before you can revise your offer, especially if you do so I don't think they will make another offer after doing this. Yeah, and always remember, no, Jaffa, it's always best to buy Jaffa when there's bad news. If you follow this stock since IPO, the best time to buy is when there's a bad news, and not so much when there's a good news. So this sector is very cyclical. So this stock has moved from 20 cents to 30 over cents I think if I'm not mistaken, this year alone. So I mean, just keep that in mind, when you're playing this stock. I think I've watched this since IPO. It's always because they always depend on the whole chicken price cycle in Indonesia, and that is ultra volatile. When the prices are up, they will get a huge supply response. Okay, let me just answer this. Can you expect property sales to get a boost going forward? CDL, Norman, yeah. And following up with the Mayor's book, I think this is going to be very positive for again, whether or not this is the right price, whether property price is actually affordable or that's we won't address that, but at least we can say that the momentum has built up, so that will help. And when with lower interest rates also will help the sentiment too. I think when there's a low interest rates. I'll answer this last one. King One, a good buy fundamentally. I read articles, Sabana 15 projects will see an increase. I don't have the details. Let us try to meet them. But so thanks for the stock idea. But let us try to meet them. Because I noticed that King One also does dorm business. So my colleague Yikban and I will try to meet this King One. There was a question on the Food Innovators IPO. So I think I typed the answer, but just to remind that the volume is very thin, only 4. And this company, so Food Innovators, the new IPO, since there's no IPO, so I guess there's a lot of spotlight. They're not truly a F&B operator. So most of the business is 21 restaurant chains, 211 restaurant chains where they act as a landlord. Landlord. So they will actually rent let's say the restaurant premise, then they will take this premise and rent it out to an actual F&B operator. So it's like, I don't know, some WeWork of F&B. The profit is 1.4 million last year, but included in the profit is actually 1.7 million of fair value gains or disposal gains, sorry. So technically, this is a loss-making company that went IPO. So that's all I can say. Whether it's good or bad, I think leave it to all the attendees here. But that's my comment on the Food Innovators. Yeah, I think I hand it over to you, Zin. Thank you.
Okay, thanks for start with the TA. Yeah, so first question is on the capital investment. I think for now it looks it probably will move a bit sideways for the time being. Some resistance around $3.05 to about $3.08 since the breakdown over here start of this month. So I think for now maybe some range trading between about 295 to about 305. The next question is on Singtel. For Singtel, I think a bit of a bounce last week since price found support at this price resistance at around $3.13, and on Thursday there was a breakout above 319, 320. So we're seeing a bit of a bounce, but I will still expect some resistance ahead, given the pullback since mid-September. Near-term resistance around 327 to 331. So I think price will still move sideways to maybe like 320 to about 326 about there. The next one is on the 103 CK Infrastructure Holdings. For this, I think price looks like it's trying to recover back above this previous support breakdown level around $54. So I think for now it should be quite sideways between about 54 to about 55.50. If price can continue to maintain above this level, I think we could see some some upside to retest the prior range resistance at about $57 to $58. Okay, next question is on Alibaba. So for Alibaba, I think continue a bit of a sideways to pull back recently. So actually seeing some support around $95, $96 over here, previous breakout level. However, it looks to be there's some lower resistance acting on it for now. Also, there was a breakdown of 102, 103 support level that's currently acting as resistance. So I think if price is unable to get back above this level to hit about 106, 107, we could still see maybe a bit of sideways or a bit of a slight downside ahead. With the next key support level around $92. Okay, the next question is Meituan. So for Meituan, I think also quite sideways as well. Price is finding some support from this previous breakout level or 171. And also, but still likely to face some resistance ahead for 190 to 200 level. So I will still expect some kind of sideways going ahead. Then 2318 is Ping An Insurance. Ping An Insurance, quite similar to Alibaba as well. Just hit the support level around 47, but still facing this downward resistance line. So we might still see some consolidation here. If you manage to break above this level around $50, then I think we might see some bounce toward like 52. There's some resistance as well. So overall, I think it'll be quite sideways. In 966, it's China Taiping Insurance. Yeah, so for this also quite range bound for the time being, just trading in the range between about $13.30 to about $15.10. So I think should be still quite in this consolidation. If you can manage to break above 15.10, then we could see a retest of recent high close to about 16.60. In 1347 is Hua Hong Semicon. So this I think price has pulled back quite a bit towards a support level here around $22. A bit of a strength today as we see price manage to break above this $24 level. I think if you can sustain above this breakout, I think we could see some bounce ahead to test about the next resistance level of 27 to about 29, sorry, 27 to about 28 over here. Next one is 939 China Construction Bank. So for China Construction Bank, I think overall still quite range. It's just range consolidation after previously a few consolidation going on. But some positive signs that still keeping at a higher low over here, support around $6. So if it continues to consolidate within this higher lows build up over here, there's still a chance of a break above $6.30. Then we could see some bullish trend continuation. Yeah, but for now, still quite sideways. Okay, then I'll just talk about the others, Singapore and Hong Kong ones first. Then if time permits, I'll talk about the US ones. Next one, Line OCBC HS Tech. Yeah, for this looks like a bit of a falling wedge going on. So there's just some bounce from a first support level around 72 cents, but resistance still from now around 77 to about 80 cents area. So quite sideways, price might still be consolidating within this wedge itself. And then next support level down will be closer to about 68 to 69 cents level. Next one is Keppel. So for Keppel, I think still quite sideways, a bit of weakness recently as price still below this 655 breakdown level. A bit of a recovery, a bit of a bounce last week, but I would still expect this 655 to 60 area to pose a bit of resistance for the time being. So I think should be quite sideways ahead as well. Then for Sembcorp Same also just range consolidation now between about 545 to 567. So yeah, I think still quite sideways for time being. Okay, then Samudra shipping, I think we should expect a bit of a rebound. Yeah, price retested this range breakout level around 83 cents, and just when you find support, just did a sideways today. We had this bullish candle with a bit of volume coming in as well. So I will expect some bounce, a bit of an upside going ahead. See whether it can test this recent high around 92 cents. Then for sets. Okay, for sets, I think still a bit of range consolidation, but looks like price has managed to but recover from this. There will be a bounce from the range support level at 356. So currently, just if you can hold at this 370 level, I think we could see some bounce further upside ahead to test the recent high around 383. The next one is Parkway Live REIT. For Parkway Live REIT, I think overall it's quite range bound for now. Main resistance is around about 415, but for now, recent price looks like there was a breakdown below 405 over there. So for now, there's some short-term resistance around there. So should be quite sideways with support still likely to hold around 390 over here, which was a previous resistance. Okay, Mapletree Logistics Trust. For Mapletree Logistics, I think overall, nothing much has changed. Still holding support around 140 over there. There's some resistance around 145, 150. So overall, still has been quite in the range since start of September. Then for city developments, I think is still holding in this inverse head and shoulders formation. So I think the key for bullish reversal is to see whether you can break above this downward resistance line, which is about 545 or there, as well as the neckline resistance at 535. Then we could see some upside hit. But for now, still looks like just kept with this consolidation. Okay, for STEC, I think it's been a bit of a range consolidation recently at this previous high resistance of 102. So just range bound between about $1 to about $1.04. Yeah, for now. This one is China Aviation. So China Aviation some pullback recently, but retested this prior range resistance at 90 cents. So I would expect some support to come in. So a bit of range consolidation perhaps between this 90-cent level to first resistance level for now 92 cents, then followed by 93.5 cents. Next question is Bank of China. Okay, Bank of China, I think it's still a bit of a consolidation over here. Still positive as still price is still holding above this downwards resistance line breakout. So above the prior resistance around 365. There's a bit of consolidation. Price can get back above 388. I think we could see some this bullish trend continue. In this question, Silver Lake. So yeah, Silver Lake, I think for now, nothing much. Still in this very tight range, 36 cents to 37 cents. For Q&M, Q&M also range bound, has been in this range since middle of July. So resistance here at 29 cents. But good thing is that price is still forming higher lows along the way. At first we have 25.5 cents, then 26.5 cents. The price is holding above 27 cents now. So overall, if can continue this trend and if there's a breakout of 29 cents, then we could see a trend continuation from this previous range. Okay, then for Comfort Delgro, I think some bounce for now after retesting this prior resistance level 142 over here, which was this support level breakdown at 147, 148. I need to post some resistance. So I think should be quite range bound as well for the time being. Trading up to about possibly trading between like 145 to about 148 area. Okay, then next question is on Baidu. So for Baidu, I think still a bit of weakness going on. I think last week we saw a breakdown below this support level at 95.60. So I think overall still pulling back. We could see price pull back a bit further to test this previous resistance over here around $88. Then I think we could see some bounce ahead. Yeah, but for now, maybe just some range consolidation with resistance at $95. The next question is on Manulife US REIT. So Manulife, I think a bit of a short-term weakness ahead as price over here since the breakdown of 12.3 cents over here. This support level has there's a resistance. Price still a bit of sideways over here, but couldn't get over this level. So for now, we should expect a bit of a weakness ahead. Some support from this short-term breakout level around 11.5, 11.6 cents. So maybe some just a bit of consolidation between this 11.5 to 12.3 cents for the time being. But if we can't hold this level, then we might see a reversion back to test this swing low, which was close about 10.7 cents. The next question is on TA for WeHer. And for WeHer, I think overall still quite a strong bullish trend over here for the time being. Price is still trading above the blue color line, which is the 5-day moving average. So for now, I think we still expect this bullish trend to actually continue. I think next resistance level for now is around 45 cents, and then followed by about 47.5 cents. Then there's a what is good to buy? What's a good price to buy Untitled Financial Holdings? Okay, for looking also in terms of TA for now, I think it's just we have a range consolidation between 40 cents, which was this prior range resistance level, then to support. For now, 42 cents is the resistance. So I think for now, for range wise, I think 40 cents will be the support level to consider buying. Yeah. Then if can break over 42 cents, then we might see a retest of this recent high around 44 cents again. And then there's a question TA for the 3 local banks. Okay, for the local banks, first up, starting with DBS, I think should be a bit of a range bound going on for now. Price retested the 39.70 high, but looks like it's facing a bit of resistance for now. So I expect just some range consolidation for time being. Support possibly at this level which you broke out, which is around 38.80. So just some consolidation between 38.80 to about 39.70, possibly for the time being. Okay, then for UOB, price is recovering back above 32.20 over here. For now, bit of a short-term resistance ahead, 32.80. But I think as long as price can hold above 32.20 over here, maybe it does a bit of a range consolidation. Then if you can break above this high, we could see a retest of this 33.30 high over here back in the end of September. Okay, then for OCBC, I think price has managed to get back above $15.20. So just looks like a slow, gradual upwards trend for now. Next resistance level around 1550, then a possible retest of the previous swing high over here around 1570. Yeah, so I think for one now, sorry, I'm able to take on still a lot of TA questions, but feel free to post in our P3 TA community group, and I'll take it over from there. Thanks for the question. I'll hand back over time to Paul.
Yeah, thanks, Zane. Yeah, sorry, I think we still see quite a lot of questions. We probably can't answer most of them. But let me just try. So I can update on Wilma. There's no new updates like we mentioned before, but we still think that in this current environment it will do well. Like we mentioned before, most of their business are actually turning around. So when you look at their soybean crushing, that is turning around. The margins are improving. Palm oil prices are, I guess, 6 months high. Even India, although there is some import duty ban, I mean, if they are prepared for that, then they should also benefit. And the lower export levy also will help the Indonesian business. So it may not be all reflected in the upcoming results, which I'm just trying to confirm the exact date. But it will be benefit them at least in the fourth quarter. Yeah. Okay, so thanks for that. Sorry if we can't answer all the questions. But if you post them in our community, we'll try to get back to you. With that, I'd like to thank everyone for your time. Wish everyone have a good week ahead, and thanks again for spending time with us and for all your questions. Thank you, everybody.